Hi, I'm Eloise Goulder, head of the Data Assets and Alpha Group here at JP Morgan. And today I'm delighted to be joined by Chris Andrew, who is head of market structure and regulatory change based in London here at JP Morgan, to talk about the evolution of the US ETF market. So, Chris, thank you so much for joining us here today.
Thank you, Eloise. I'm delighted to be here as usual.
And Chris, this conversation really follows many discussions that you and I have had, 3 of which are on this podcast series, about volume and turnover ratio trends over time, with the stark observation about the relative decline in turnover ratios in Europe versus the increase in turnover ratios in the US and in parts of Asia. And we've discussed the drivers of those dynamics, including the influence of the retail investor and of passive funds and ETFs or exchange-traded funds. But we've never really dived into detail on the ETF part. So I'm really looking forward to hearing about your work in this space.
Thanks. The more I look at some of these topics, the more I see common threads running through them, which really fascinate me. And there's definitely a strong retail thread running through the ETF story, both in terms of direct trading by retail participants and through retail assets increasingly being directed towards those instruments.
Interesting. And Chris, why exactly have you turned your attention to ETF markets more recently?
I think it's mainly just something that, at least on the market structure side, we've not looked at in depth for some time. Also, it is huge. Some 30% of US trading volumes by value are attributable to ETFs. And they account for about $9 trillion of assets under management, or AUM. And it's continuing to evolve, so I really think it's worth a visit. Just before we start, I really want to say that I'm indebted to my colleagues Julie Abbott and Matt Legg from the ETF sales teams in London and New York. Many of the insights that we're going to discuss today come from them.
So you said about 30% of US equity market trading is in ETFs. That's an incredible stat.
Yeah, so that's around $150 billion per day of ETF trading, so roughly 3 times what the whole of developed Europe trades in ordinary shares each day. And our prior discussions about the scale and structure of US versus European markets are just as relevant to ETF markets as they are for shares. And also, they're driving forces in the way those markets are diverging.
Totally. So the last time we spoke, we talked about the significant presence of the US retail investor in US markets and, in fact, the concentrated presence in certain stocks. So, Chris, do you have a sense of how that retail appetite has influenced the ETF market more recently?
Yes, I do think the data are revealing a few things here. And it's worth emphasising that while ETFs are consumed heavily by retail investors, they're also used extensively by institutional investors for the same purpose. And we should probably come back to that a bit later. But just to answer your question, from 2014 to 2019, net fund creations, that's new funds minus funds closing, ran at about 100 funds a year. From 2019 to 2024, net creation of ETFs ran at about 360 funds a year. But in the last year alone, the ETF population has increased by around 460 funds. So the growth in growth, if you like, at least in terms of instrument creation, is quite staggering. And if you look at the chart, which is in our full report to clients, it's evident that there's a notable shift in the pace of ETF creation, which begins during the pandemic at around the same time that we see the boom in retail activity in the general equity market. Difficult to imagine that those two are not linked.
Yes, and at the same time, it's been well documented that, in general, US assets have been moving away from mutual funds and into ETFs, and the pace of that has also accelerated in recent years. But I guess there's really 2 concepts here. There's the flow of funds into ETFs, so the demand for ETFs on the one side, and then there's the creation of new ETFs, so the supply of ETFs on the other side. So how do you think these 2 sides of the market are really linked?
I think the causal direction is worth talking about. That's to say, is ETF creation driving demand for them, or is the demand for ETFs driving the creation of more instruments? And of course, ultimately, it can be both, but for now, I think it's mainly the latter. In our report, we look at the distribution of AUM across newer and older funds, and we find that although 50% of all instruments have been created in the last 5 years, those products only represent about 9% of total AUM, which is about $800 billion. However, in the last 5 years, ETF AUM has increased by about $4 trillion. So although there's undoubtedly demand for the newer funds, older funds have actually been attracting most of the inflows in that period so far.
Interesting. So it looks like ETF issuers are looking at a growing market for ETFs and trying to capture part of that market. And also, the picture you paint on the supply side is of quite a competitive market, given the significant pace of new ETFs coming onto the market. So, how would you say issuers are looking to compete with these highly established ETFs?
Well, as you suggest, existing funds covering vanilla indices or sectors have a first mover advantage, which is difficult to overcome. So the types of fund being created in recent years are either increasingly specialised or covering underlying asset classes which may have been underserved. That increasing specialisation in the equity space has a couple of themes in my view. Probably the biggest trend is towards issuing actively managed ETFs. In the last 2.5 years, these made up around 2/3 of newly issued ETFs and have taken up a similar proportion of the AUM.
That's fascinating that 2/3 of the newly issued ETFs have been in the active space. Quite counterintuitive when you think about the total AUM, which is still so dominated in the passive space. But Chris, how do you define what an actively managed ETF is?
I agree, it's quite a departure from the original ethos of the ETF. The definition of the actively managed ETFs that we're talking about is that the issuer is not committed to tracking a defined reference index and will instead try to outperform a given benchmark. In other words, the ETF manager has discretion. But I would say this is actually just a natural continuation of the way in which the industry has been evolving for some time as issuers look for gaps in the market.
So we've covered the traditional passive ETFs, still where the vast majority of AUM lies. And then we've spoken about the other end of the spectrum, the active space, which is relatively small in terms of AUM, but rapidly growing, as you say. And then what about the space in the middle? Is there a bit of a blurred line between what is defined as passive versus active?
Well, I think yes and no. So, yes, in the sense you can find very similar sounding ETFs which appear to share a very different investment objective or theme, and one will be actively managed and the other one will be passive. But I think the bit in the middle was the development of quite sophisticated ETFs targeting quite specific and sometimes quite technical exposures, but still doing that in a rules-based way. So, in other words, without discretion. So these products are passive in the sense there's no discretion to deviate from the underlying index, but in some senses they can be more active than the big traditional benchmark products. In other words, even though the reference index is rules-based, it can still be doing quite a lot of heavy lifting and rebalancing more frequently than a major benchmark index. Also, the reference index can be created by the issuer itself, or it can be created by the firm that will almost create a specific index on request for an issuer to meet a specific investment objective.
I find this active and, if you like, quasi-active ETF space a really fascinating one because it overlaps so much with the work we do on the data and on the alpha signal side, with this idea that more traditional alpha strategies, say value, growth, momentum, buybacks, multi-factor, are becoming more accessible to more investors, democratizing those sources of alpha. But at the same time, potentially eroding those sources of alpha because they are becoming more commoditized by definition. I mean, Chris, are these the sorts of factors that you also see replicated in some of the more sophisticated ETFs?
Yes, I think I see all of those individual factors and we see multi-factor ETFs, but they also cover more thematic objectives. So think like innovation, millennial consumers, different political leanings, clean energy, inflation, shared self-driving technology, cybersecurity, and so on.
And again, on the thematic side, it also speaks to ETFs, meaning wider availability of these strategies now available to, say, the retail investor via ETFs, whereas historically, perhaps those thematic strategies were more the preserve of the institutional investor. And can we just go back to this question about the types of investors that are driving the expansion of the ETF market? Because we spoke earlier about ETFs being a retail-friendly construct, but the fact they're also used by institutional investors. So what is the AUM split between these two?
So one end of the spectrum, let's start with what we're going to call pure retail. And by that, I mean individual investors making their own decisions about which ETFs to hold. And then at the other end of the spectrum, we've got traditional institutional investors, which may primarily invest in stocks and shares, but also use ETFs to efficiently gain or trim exposures to different parts of the market. And that could be based on geography, sector, theme, risk premium, etc., etc. And then you have something in between, which we're going to call managed wealth. And that's where advisors are taking on retail money and investing that money into a variety of ETFs, often on a systematic basis. Now, it varies quite a lot between different types of product, which we can come back to, but by our own estimates, we would say that for the market as a whole, pure retail activity accounts for around 40% of US ETF assets under management. Traditional institutional activity, we would put at about 20%, and the remaining 40% comes from managed wealth advisors.
And presumably, if we look at that pure retail business part, then part of the driver for their focus on ETFs rather than traditional mutual funds is the immediacy, the ability to trade quickly and track closely the performance of those strategies.
Yes, I think that's absolutely right. And worth bearing in mind that on top of the pure retail business, which is about 40% of AUM, bear in mind that we see another 40% in that managed wealth category, which means that it will be retail money invested at the discretion of their managed wealth advisors.
So interesting. So put together, that represents about 80% of the US ETF market. And you mentioned that the levels of participation between different investor types varies quite a lot from ETF product to product. So Chris, what have you found there?
Well, I think I can only really give a flavour of this because the array of ETFs available to investors now is mind-bogglingly large. But there's a few things I can say. So let's say we start with the core, old, established ETFs, which are really the backbone of the market. So the most liquid S&P 500 ETF trades about $30 billion a day and has about $500 billion under management. That 30 billion, by the way, is not far off what the whole of developed Europe trades in a day. Now, that product seems to be used by all the participants we've talked about. So I think retail, managed wealth, and also traditional institutional investors. And why do they do that? I would say probably for the trade efficiencies. If you look at the economics of trading an S&P 500 ETF versus trading the underlying shares, well, first thing in the morning, the spread to trade a basket of S&P 500 shares is about 8 basis points, whereas you can trade that ETF for about a quarter of a basis point and get the exposure instantly. But then if we look at the other end of the spectrum, actively traded ETFs that have less than 20% institutional ownership, so these are largely used only by pure retail investors. Here we see much more of a kind of rapid positioning behavior. These are often in leveraged products with volatile single stock or sector underlyings. And here the user is probably trading the ETF to gain a very quick exposure to a theme in response to a certain catalyst. Many of these ETFs have turnover ratios in the region of 2,500 to 7,000 basis points. So they're turning over 25 to 70% of the assets under management each day on average. And that is really off the charts compared to some other ETF products. And then finally, if we think about products with the highest absolute levels of retail ownership, in other words, where most of the money is actually parked as opposed to what is being most actively traded, has tilted much more towards traditional benchmark and broad-based indices. And even here, it's interesting. You can actually see retail money tending to favour the trackers, even in the same index that have lower expense ratios, rather than those which are most liquid in the secondary market, which those tend to be favoured by institutional investors for obvious reasons. And one more thing, we see that when we've got an ETF that's doing more of the heavy lifting by itself, either because it's active or quasi-active, as you described, we find that the turnover ratios are lower in that instrument. So that means the more sophisticated the ETF itself is, the more investors will generally just leave it to do its thing rather than trading in and out of it vigorously.
It's so interesting and it's so complex because, as you say, there are so many different types of ETF, from passive to quasi-active to active, some of which are traded rapidly, others more in a buy and hold type capacity. And some, those super liquid established index ETFs, used because of efficiencies in trading costs, while others used to gain specific exposure to themes or to traditional alpha strategies. But overall, it's clear that the retail investor is pretty dominant in the ETF space, whether investing directly or via managed wealth advisors. And no surprise, perhaps, that as the retail investor has grown in share of volume in US markets, we've also seen this enormous growth in ETF flows and ETF creation more generally.
I think I'd make one point about the dominance of the retail investor. I think the retail investor's assets are dominant, but if you think about how the business is directed for that other 40% that comes from the advisors, it's clear that the way that those advisors evolve, how they think, how they rebalance that activity, those advisors themselves are now very influential in the market as well as the investors themselves.
Yes. So finally, Chris, to come back full circle, we've spoken at length about the US versus Europe volume dynamic, growing in the US and declining in Europe over the last 5 or 10 years. And you've spoken here about the growth in the US ETF market. So how does this ETF dynamic really play into the wider volume dynamics that we've discussed in the past?
So I think, firstly, there's been plenty of development in the European ETF market, driven by many of the same issuers who operate in the US market. And assets under management within the European issued ETFs reached the $2 trillion mark this year. And there are over 3,500 products available. But the way in which the two markets operate, particularly from the point of view of secondary markets trading, is very different. And that's largely driven by the fragmentation of European financial markets infrastructure on national lines. Within Europe, national retail distributions tend to be integrated with the legacy national financial markets infrastructure. So think of that as the main exchange, the clearinghouse, the central securities depository. So while some specialized ETFs aim towards the retail market in a particular country, may be only listed on that country's exchange, products with broader appeal are usually listed across a number of European primary exchanges, often in different national currencies. Now, the different listing currencies and places of settlement make those listings difficult to aggregate, even with the use of technology. And the result of that is that it's much more difficult to build any kind of critical mass of secondary market liquidity in any one listing on which participants can converge. As a result, the European ETF market is heavily reliant on intermediaries to make markets both to retail and institutional investors and to manage the fragmentation across those listings. So whereas in the US, investors can usually trade very large positions in ETFs on exchange or on screen in the parlance without having to use an intermediary to provide liquidity, in Europe that is much less the norm, particularly for non-retail activity. So I just think it's another example of where Europe's geographical fragmentation and lack of truly pan-European listing and post-trade infrastructures prevents it from scaling up its capital markets.
Well, we're back onto the European fragmentation argument again. Would you at least argue, Chris, that there is a growing recognition of this problem?
I think so. I mean, funnily enough, I was just starting to read Mario Draghi's report yesterday, and it's interesting that he mentioned some of these issues specifically. And one of the things he calls for is for the collapsing of a lot of the European post-trade infrastructures, precisely to mirror the situation that they have in the United States. And I think that will be well received by a lot of people like me who sort of look at Europe in perhaps a bit of a technocratic way. I think that the big question really is whether that is going to be acceptable politically.
So thank you so much, Chris. You've really managed to pull together so many of the prior discussion themes that we've had and wrap them into this specific ETF topic. So thank you for taking all the time to discuss your analysis today.
Thanks, Eloise. It's been a real pleasure.
And thank you also to our listeners for tuning into this bi-weekly podcast series from our group. If you have feedback or if you'd like to get in touch, then please do go to our website at jpmorgan.com/market-data-intelligence, where you can reach out via the Contact Us form. And with that, we'll close. Thank you.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. The views expressed in this podcast may not necessarily reflect the views of JP Morgan Chase & Co. and its affiliates, together JP Morgan. They are not the product of JP Morgan's research department and do not constitute a recommendation, advice, or an offer or a solicitation to buy or sell any security or financial instrument. This podcast is intended for institutional and professional investors only and is not intended for retail investor use. It is provided for information purposes only. Referenced products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JP Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com www.ms.com/disclosures/sales and trading disclaimer. For the avoidance of doubt, opinions expressed by any external speakers are the personal views of those speakers and do not represent the views of JP Morgan.